Are you thinking about moving to a zero income tax state? Well, think again. At least wait until you watch this video. Hello everyone, my name is Zach, and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. In order to best illustrate my point here, let's do an example scenario. In our example scenario, we have two people making the median personal income. And if you look up the data on the median personal income, it's around $40,000 per person. And if both are working full-time, then they should be earning about $80,000 per year. And this is pretty close to the median household income. And of course, it varies based on what kind of household it is, but the median of the median, our $80,000 is pretty close. And then when they're looking to retire, they want to know how much of their pre-retirement income they're going to need for their retirement spending. Well, Fidelity estimates that most people will need about 70% of their pre-retirement income in retirement. They give a little bit of range there, but right there in the middle is about 70%. So that's what we'll use. $80,000 times 70%, that's about $56,000 per year that our hypothetical couple is going to need to spend in retirement. And kind of funny enough, if you look at the median household income for those over age 65, which is the kind of household that's most likely to be retired, that's really close to what their median income is. So I think we're pretty good here. We're pretty spot on based on with the median that most people will need, somewhere around this number to spend in retirement. All right, now that we've got that out of the way, we know how much they're going to be spending. Let's look at the zero income tax states. So currently, at least as I make this video, these are the zero income tax states that we have here in the United States: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. Then there's a few others that are kind of in a gray zone here, such as New Hampshire. New Hampshire has zero income tax on earned income, but they do tax interest and dividends currently. And then we also have Washington State. Washington taxes capital gains. Those gray states, the ones that aren't exactly zero income states, are the ones that you have to keep in mind when you're thinking about early retirement, when you're thinking about financial independence, or even just regular retirement, because there are different types of income that you can receive. And therefore, some states are going to tax different types of income differently. Now, before we get on to different types of taxable income, I just want to interject here really quick and just say that zero income tax is one of the reasons of many that I chose to move to East Tennessee. And if you're curious to know about why I moved to East Tennessee and a lot more reasons and how it went, I do have another video, but we'll talk about that again at the end of this video. All right, getting on to the different types of taxable income. Let's look at it from the angle of different states that tax different types of income differently. So for example, there are some states that do not tax retirement income that comes from retirement accounts. Those states are Iowa, Illinois, Pennsylvania, and Mississippi. Those have all joined the chat here. And then there are two other states that will not tax pension income, which is a form of retirement income. And those states are Hawaii and Alabama. So what you can gather from this is that if most of your income in retirement is going to come from retirement accounts and or from a pension, then you have a lot more options than these standard zero income tax states, because those other states that I just mentioned are also not going to tax that type of income that you're going to be receiving. So you might have a very large portion of your actual income in retirement that's not going to be taxed even if you live within those states. And of course, I have to mention there are plenty of states that do not tax Social Security. Fortunately or unfortunately, for many Americans, Social Security is one of the major components of their retirement income. So go ahead and just take a look at this map here. These are the states that do not tax Social Security income, and that is a lot of them. So if Social Security is income that makes up, like, let's say half of your income, then that's half of your income that won't be taxed in one of these states. So there are a lot more options if you derive the majority of your income from Social Security or from retirement accounts or from pensions. Now, the reason why I titled this video as is because you can move to a state with zero income tax, but depending on your individual situation, you might end up paying more or less taxes in other categories, right? States, they get tax revenue in many different ways, and income tax is just one of those ways. Depending on how you retire and how much you retire with and what kind of lifestyle you're living in retirement, you might pay more taxes in a zero income tax state than you would in a state with income tax. And one way that you could do that is through property taxes. Property taxes vary dramatically by state to state. For many of us, when we choose to retire, achieve financial independence, we choose homeownership. And if you have homeownership, that means you have to pay property taxes. And wouldn't you know it, all 50 states have property taxes. Pretty much you're going to pay property taxes with very few exceptions. Take a look at this map here. It's really cool. It shows the amount of property taxes paid based on the area. If you see a darker area, that means higher property taxes. And if you see a lighter area, that means lower property taxes. Pretty cool to look at that. looking at it on a area basis, more like a county basis, is much more accurate. It is more important to look at it on a more specific area rather than on a state level, because mostly property taxes are going to be managed by local governments. But that brings up an important point here when it comes to property taxes. Not only do you have to look at the rate, like the percentage of what you're paying in property taxes, but you also have to look at the median home values of the area you're going to be moving to. Because even if you move to a relatively low percentage property tax area, the median home value could be so high that your absolute amount of property taxes ends up being very, very high. So it just depends on where you move to. Here's a really good example to illustrate this. Look at California. Their average tax rate is put at 0.66%, but that leads to a $6,500 per year average tax bill, which is very large. And that's because the median home values in California tend to be very, very high. Now look at something that's a little bit on the other side of the spectrum here. Let's look at Texas. Texas has a much higher percentage, double that of California nearly, at 1.25% on average, which is pretty high. However, that leads to an average of $4,800 per year of a tax bill, which is still pretty high in my eyes, but it's still lower than the California average tax bill, even though the property tax rate is higher in Texas. So don't forget to neglect looking at property taxes in an area that you're planning on moving to if you're factoring in taxes as your reason. The next tax that you need to pay attention to is sales tax. This might get you. But before I get into that, I just want to say really quick that I put a lot of research and effort into videos like this, especially trying to look up all this data and compile it all. And I would really appreciate it if you help me out by hitting the like button on this video. Thank you very much. All right, but getting back to the sales tax. Sales tax can be a relatively large amount of tax depending on how much you spend. Obviously, if you live somewhere with a relatively high sales tax and you spend more in that area, then you're going to pay more in tax. Whereas if you're living on a more lean budget, a smaller amount of spending per year, then you pay less in absolute tax. But it's still going to be, about the same percentage of your income, because sales tax is supposed to be the same percentage no matter what you buy, right? So the more you spend, the more you'll pay in tax. The less you spend, the less you'll pay in tax when it comes to sales tax. But this is important because if you plan on moving to a zero income tax state, but they have a very high sales tax, and you plan on spending a lot of money there, like a F.I.R.E or something like that, then you might end up actually paying a relatively large amount of money in taxes every year due to sales tax. For example, I moved to Tennessee partially because of the low income tax, but Tennessee usually ranks at number 1 or number 2 in sales tax in the country. So the average sales tax in Tennessee is 9.55%. Almost 10% of everything you buy is going to be going to tax. So you can go ahead and add 10% to anything you plan on buying here in Tennessee to find the real price that you're going to be paying. And of course, I have to mention, there are some states that do not have any kind of sales tax. Definitely keep sales tax in mind when you're planning on your retirement. If you're planning to move somewhere, and tax is one of those reasons why you're planning to move somewhere else, because sales tax can be pretty large if you're spending a lot of money. Let's get back to the income tax, because one important thing you do need to keep in mind is that when you look at income tax, like on a state level, usually what it's listed is the highest marginal tax rate, right? But for most of us, we're not going to be in that highest marginal tax rate. If you're spending around the median income, or maybe a little bit less or a little bit more, you're probably not going to be in that highest marginal tax rate within that state. So you have to dive a little bit deeper to see what kind of tax rate would you realistically expect to spend in that state. I'm going to go back to California for the example here, because California is known to have the highest marginal tax rate. However, if you're spending around the median income, you are not going to be paying anywhere near that marginal tax rate. A couple that is married filing jointly living in California with $56,000, they are only going to be in the 4% marginal tax rate. And I'm sure there are plenty of other examples of high income tax states with the marginal tax rates being so high on a large amount of income that it's just not going to apply to most of us. Now, really quick, this leads me to the big question here. I want to know from you in the comments below. Do you plan on moving somewhere else than where you currently live? And part of that reason would be for tax reasons. Do you plan to move somewhere to save money on taxes? Please let me know in the comments below. I'm really curious to hear what you have to say. And now let's try to put all of this together, right? We've talked about income tax, we've talked about property tax, we've talked about sales tax, and we've talked about, marginal tax rates. So let's try to put this all together so you can kind of think about all of this as one kind of thing to learn about what is your total tax burden going to be in retirement, in early retirement, or financial independence. All right, and for this next part, I put together a pretty cool little spreadsheet here to try to analyze the different amount of tax burden you would have spending this median income. I didn't put every single state in here, but I put almost half of them. 24 states we analyzed here. The no income tax states are going to be highlighted in gray. The flat income tax states are going to be highlighted in kind of like an orangish color. The no sales tax states are going to be highlighted in kind of a blue color, and the no income tax on our example states are going to be highlighted in a slightly yellow color. So we have the standard deduction at $29,200 and our total retirement spending of $56,000, because different states will sometimes take that standard deduction and apply it to their state income tax while others don't. So I had to look all of this up on my own. Maybe it's not perfect, but I think it's pretty close. So let's look at this here. We have these 24 states here, and then I have the median property tax, and I have the sales tax, and I assume that half of all of your spending will go to regular sales tax. And then I put the median sales tax rate in there, and then we use that to calculate the total tax burden. I then went ahead and repasted everything, ranking it from 1 to 24. And you can see right here, the number one loser is Massachusetts at rank number 1 with the highest total tax burden of $11,154. And then California is right there in second place. Then we go down the line here all the way until 24, and believe it or not, the state of Mississippi won the lowest tax burden. Mississippi in last place, which is actually good, with the lowest tax burden of $3,291. Following that is Wyoming, Delaware, and then Tennessee. And there you have it. I did move to Tennessee partly because of income tax, but there's definitely some other reasons as well. And if you want to know my full story on why I moved to East Tennessee for early retirement, I have another video for you that's going to pop up right on the screen, and I'll put it in the pinned comment below as well. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time. What kind of tax rate would you realistically... It's going to be up on the screen anyway, so it doesn't matter.